Early July 2026 presented a perplexing reversal in the Bitcoin market. After weeks of sustained outflows, Bitcoin exchange-traded funds suddenly registered significant inflows, challenging prevailing bearish sentiment. This abrupt shift demands a precise analysis of the underlying catalysts. The preceding month of June 2026 saw considerable pressure on Bitcoin, marked by substantial ETF redemptions. Investors pulled an estimated $4.5 billion from U.S. spot Bitcoin ETFs, a record monthly withdrawal since their inception in January 2024. BlackRock's SIBIT alone accounted for approximately 75% of these outflows, signaling a broad institutional retreat. This period of capitulation pushed Bitcoin's price below the psychological 60,000 level, reaching a 21-month low near 58,000 by early July. The crypto fear and greed index plummeted to a level of 11, indicating extreme market fear. This downturn primarily stemmed from a challenging macroeconomic environment. The Federal Reserve maintained a restrictive monetary policy, holding interest rates at 3.75% in June 2026 and signaling a propensity for further hikes rather than cuts. This stance elevated real yields, increasing the opportunity cost of holding non-yielding assets like Bitcoin. Consequently, Bitcoin exhibited behavior akin to a high-beta technology stock. Geopolitical tensions, particularly the ongoing conflict in Iran, also contributed to inflation concerns and a risk-off sentiment across global markets. This confluence of factors created a formidable headwind, intensifying selling pressure on Bitcoin and its associated investment vehicles throughout late May and June. However, the tide began to turn dramatically on July 3, 2026. U.S. spot Bitcoin ETFs collectively recorded $221 million in net inflows, breaking a preceding 10-day streak of outflows. This sudden influx of capital immediately improved market sentiment, initiating a nascent recovery for the digital asset. A primary catalyst for this reversal was the release of U.S. economic data, which unexpectedly undershot expectations. The June non-farm payrolls report indicated a modest addition of only 57,000 jobs, significantly lower than the anticipated 115,000. Concurrently, the unemployment rate edged up slightly to 4.2%. This softer labor market data prompted a reevaluation of the Federal Reserve's monetary policy trajectory. Investors began to price in a higher probability of less hawkish rhetoric and potential rate cuts later in the year, moving away from the higher-for-longer narrative. In direct correlation with this shift in interest rate expectations, Bitcoin rebounded significantly from its recent cycle low near $57,000. The market interpreted the macroeconomic signals as a potential easing of financial conditions, making risk assets like Bitcoin more appealing. This response underscores Bitcoin's sensitivity to liquidity. Beyond these short-term macroeconomic fluctuations, a deeper structural shift underpins the renewed interest. Michael Saylor, a prominent institutional advocate, asserts that institutional capital flows have become the primary growth driver for Bitcoin, overshadowing its traditional halving cycles. He posits the next decade will be characterized by profound institutional adoption. Saylor envisions Bitcoin evolving into a fundamental layer of global finance by 2036, serving as a reserve asset for retail investors, corporations, banks, funds, and sovereign states. Its role as a scarce global asset will become the foundation for capital, credit, and financial infrastructure. The U.S. spot Bitcoin ETFs now collectively hold approximately 1.3 million BTC, solidifying their position as one of the largest single holders globally. This concentration means ETF flow data has become the most critical short-term price signal in crypto. Inflows mechanically necessitate spot BTC purchases, directly impacting market demand. The institutional era for crypto is accelerating faster than many anticipated. Major financial institutions, including large asset managers and wealth managers, are actively expanding their distribution channels for digital assets. This enables broader client access to Bitcoin exposure through regulated investment vehicles. Analysts predict a significant surge in Bitcoin ETF assets in 2026, potentially reaching $180 billion to $220 billion. This forecast is based on historical patterns observed in gold ETFs, where the third year post-launch typically sees an acceleration of flows as cautious institutions move towards mass adoption. Crucially, a progressive shift in the regulatory landscape is bolstering institutional confidence. The U.S. Securities and Exchange Commission unveiled the 2026 regulatory agenda aimed at developing a comprehensive framework, including a safe harbor proposal. This signifies a move away from an enforcement-driven approach towards formalized rulemaking. The SEC's initiatives focus on clarifying rules for token offerings, financial responsibility for broker-dealers handling crypto assets, and structuring digital asset trading venues. These clearer guidelines are anticipated to reduce legal uncertainty, thereby strengthening institutional participation and encouraging further integration into traditional financial models. This enhanced regulatory clarity is critical. 73% of institutions now plan to increase their crypto allocations, with 66% already accessing the market via regulated ETFs and ETPs. Legal certainty provides the confidence necessary for these large capital allocations, reflecting a transition from speculative enthusiasm to strategic positioning. The traditional Bitcoin halving cycle, once considered the primary driver of market dynamics, is diminishing in influence. Instead, the confluence of robust ETF flows, global liquidity conditions, and maturing market infrastructure now dictates Bitcoin's cycles. Institutional demand, not supply shocks, drives growth. Further supporting this structural shift, a recent K33 research report indicates that the market is transitioning from a heavy distribution phase to net buy-side demand in 2026. This suggests that long-term holders are slowing their selling, while institutional accumulation is poised to increase, indicating renewed optimism. Consequently, expert predictions for Bitcoin's price by year-end 2026 range widely, with many forecasts placing it between $100,000 and $200,000. This renewed institutional buying, spurred by improving macroeconomic sentiment and regulatory clarity, represents a pivotal moment, signaling a sustained re-engagement of significant capital with the asset class.